All right. Well, thank you everyone for attending this month's market update webinar for August 2023. Let's begin with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed within the presentation. And of course, past performance is not a guarantee of future results. You can see our website for additional disclosures. And throughout the presentation, you can submit any questions using the Q&A button at the bottom. Quick bio about myself. My name is Jeremy Eppley. I'm an accredited investment fiduciary, accredited portfolio management advisor, and chartered retirement planning counselor. You can learn more about me on my LinkedIn. And Silverstone Financial is a fee-only fiduciary registered investment advisor. We provide comprehensive wealth management services, including financial planning, investment services, tax services, and estate services. You can learn more about us on our website. So this last month, in July, it says August, but this is showing the last month for July was quite a good month. It was almost all green throughout all the indices tracked here, except for Bitcoin was slightly down. That was due to some regulations and continued enforcement action by the FCC, the government and the SEC. Sorry. The Dow Jones, S&P 500, the mega cap stocks, which would be mostly the NASDAQ, traded very similarly, all within 3%, surprisingly enough, the S&P 500 and mega caps being exactly equal, even though the mega caps, at least this indice, only holds the top 50 of the 500, the S&P 500. So top 50 match the performance of the bottom 450 and the top 50 included. Just an interesting thing that you don't see that often. Small caps outperformed slightly this month, while global non-US stocks still performed quite well, but slightly worse than everything else. Bonds did basically nothing this month. Their total return was flat at 2 basis points. Gold kept up with equities at 4%, quite well. And oil had a bounce back up to 15%, which led, as you can see, some of the oil producers were up quite large this month. It was interesting to see the oil's futures trade. It was up and down, but mostly up. It was very interesting. Meta also doing quite well. I got to point out Meta and Nvidia 13-14% this month. It was very interesting to see. Year to date, we have a great performance continuing. Mega caps is the main one that jumps out at me at 30% still, which is incredible considering last year they were down significantly. It was a retreat to safety last year. And this year, basically what had happened was a lot of the tech names, the mega cap names, the growthy names were oversold. And a lot of the fears of a hard landing because of the Federal Reserve raising interest rates, and a lot of the fears about inflation, all those kinds of fears haven't materialized, even though they have been projected for by, I would say, the majority of analysts and economists. We've done quite well, or at least the economy has been more resilient than was expected. So money, capital flooded right back into those mega cap names that were, at least in historical values, at a slight discount, even though they traded a premium to the rest of the market. There isn't that much more to say year to date, I don't think, other than pointing out Meta again at 164% up year to date, which is crazy, mostly because it had an absolutely horrendous 2022. However, this year has quite, you can say it's made up for itself and more. Those that bought it at when it was $100 per share last year are quite happy with the performance. Bitcoin's the only other index that I wanted to mention, up 76%. Mostly that came from the beginning of the year. After it jumped right after December, and January, February, it did very, very well. And it's been kind of trading flat, slightly up, with a lot of volatility, of course, because it's Bitcoin. But it's been interesting to watch the crypto markets react to the rest of the market going into more of a bull mode, getting out of that dreaded bear market. Because you got to remember, even though Bitcoin is seen as completely independent, uncontrollable, all those kinds of different words you can attribute to it, it is still very correlated to at least the NASDAQ. I think it was 60 to 70% correlated. I might have those numbers wrong. It was a while ago that I had researched it, but it definitely trades alongside the NASDAQ and what we call risk on assets. When there's an appetite for risk, a lot of different risk on assets move together, and Bitcoin is one of those. I wanted to spend a little bit of time today to discuss inflation. We hadn't discussed how inflation has been finally turning a corner. Of course, it's been coming down, which was expected. A lot of the inflation, although transitory, was never, it didn't come to fruition. Inflation was never really expected to come down this quickly. A lot of it, I can't actually say that. There's quite a few analysts and economists that did see inflation coming down this quickly. But I would say I was in the slightly more pessimistic camp that it would take inflation a long time to fall back to these levels. 2 months ago, I had talked about it was likely going to get to 3% by July, which is what happened, mostly because as long as we had what we were seeing in the beginning of the year, which was this is our month-over-month data. It might be a little hard to see. I apologize. But the month-over-month data in this top right corner, as long as it's under 4 basis points, we were expecting, or 40 basis points per month, we were expecting to hit 3% in July or August, which we hit. And thankfully, we see these inflation expectations down here compared to the actual inflation rate that was announced each month. We were slightly hotter for 10 months. And then finally, in June, or this would be May, I apologize, we hit the same, we met expectations. And then in June, July, we finally exceeded expectations. And we're starting to cool slightly faster than what was expected a few months ago, which is nice to see. This green line that I put on these graphs, that would be the month-over-month inflation that we would need to hold consistently for 12 months to approximately have 2% inflation per year, which is the Federal Reserve target. They've said multiple times that they're going to raise rates until they get it back down to 2%. I'm in the camp of a few analysts that say we're at 3%. It's not that bad. Historically, we've been under 2% inflation. So if we look at the very long picture, running a little bit hot for a few years at around 3%, isn't actually that bad. And what would be worse would be to over tighten and to crush the economy and make people lose their jobs, to force us into recession just to get that last 1%, the last 1 mile, as we say, of inflation reduction. And right now, we're slowly reducing the inflation rate. We're at 3%. We've had a great trend, as you can see. And we're probably going to even off now because this was last year's month over month. And all these very large numbers have all cycled out of the calculation for this year's year-over-year data. So most likely, in my opinion, we're going to be hovering around 3%. Slowly making our way towards 2%, because I believe the Fed when they say that they're going to continue to hold interest rates high and or raise them higher to get to 2%. But that last chunk is going to take possibly a year or 2 years or 3 years even. And it really depends. Eventually, pain will be felt in the economy with very high interest rates. People will lose their jobs and such. And it really depends on how much pain and criticism, essentially, that the Federal Reserve is willing to take to get that inflation down. We're going to have to see. We're going to have to see. But I think out of these four graphs, what we got to take away from it is to look at it positively. And this is what we were seeing 2021, 2022. This was the same line as you can see up here, where it would be 2% inflation over year. And we were running quite hot. The lowest we got was 40 basis points. And the highest we have now in the past year was 50 basis points. And we see quite an improvement, drastic improvement, as this is being the highest and this being the lowest. And we had numbers as high as 1% inflation per month a year ago, 2 years ago, which is incredible. And everyone should be very grateful that the supply chains fixed themselves, the financial system tightened itself alongside, a little bit of coaxing from the Federal Reserve. But inflation not becoming ingrained in the economy, that the 70s weren't a great time for the US economy because of the extremely high inflation. Being able to get away from that is great to see. Really quickly, looking over what the Federal Reserve did over the past 2 months. In June, we had a pause. A lot of people thought it might have been a permanent pause and they were going to hold it steady, but they bucked that trend in July, just a week ago or so, when they announced they're going to increase by 25 basis points, and we're going to make decisions every few months. Every meeting would be independent, data-driven, and seeing this trend where it's hopping back and forth, we might see 0 and then another 0 and then a rate hike and then 0 and then a rate hike, something like that. And the market saw that as positive to see that the Federal Reserve wasn't going to start really tightening everything like crazy after giving a pause. There was that fear that it was going to be a fake pause. They're going to start ramping by 50 again. I heard a couple commentators say some very hyperbolic things about the Federal Reserve, and it seemed that their Jerome Powell's comments, the Federal Reserve chairman, and their actions have calmed the market. And we'll get into the performance and some future expectations, but seeing how the market has reacted these past 2 months is very interesting to me, because I don't know how sustainable it will be. And I'll save those comments for when we get to the chart, but it's great to see because the market's up, people are feeling better, there's less fear, less anxiety. And I listen to commentators every day and analysts, and you can hear the anxiety in their voices when the markets are down, and they really do believe that there's going to be a hard landing any day now. There's going to be a terrible jobs report where we saw that there was a ton of layoffs. But essentially what we've seen so far was January, February, December, 6 or so months ago, we saw large tech layoffs, and then that didn't ripple across the rest of the economy. And those tech workers were quickly hired back by different firms, not necessarily the same firm that they left from. Most of there were a lot of firings. I think it was Amazon, Google, Facebook, definitely Twitter, which isn't necessarily because of the economy, but because of a change in management. But there was also a lot of hiring from Facebook and Apple and such. So not seeing those layoffs hitting the really bad, say, like if Walmart started laying people off, or UPS, a lot of these backbones of how the American economy works, and regular people, average people, losing their jobs rather than very high paid and very specialized tech workers that have what most economists would consider pretty strong job mobility. They get fired, and if there's a trend throughout their industry, it could be quite bad. But thankfully enough for them, they were able to find a job rather quickly because their skills are still in demand, and we haven't hit a recession, so these large companies are still able to be paying their high salaries and to continue to build out their whatever technology platform they're working on. So the next slide will be the chart that I'll have quite a few things to say. But I wanted to point out before we get there, we're getting into the two worst historical months of the year, August and September being the worst one on average. Now, of course, this is an average over basically 100 years, and it does not guarantee in any way or predict with any certainty what a specific year, a specific month is going to do. But there is a natural cyclicality to the markets. And because of that, there's going to be added pressure, added weight in these coming months. So essentially, if we see a strong surprise to the downside in any kind of economic data, like a jobs report or a really hot inflation number, or the Federal Reserve surprises something on us, or there's some sort of other big, large bank collapse, which we haven't seen for the past few months. So we're very lucky we didn't have a contagion effect that we were worried about in the spring when Silicon Valley and the other Silicon Valley Bank and the other large banks were failing. Not seeing any of those, we could continue to see strong performance in the next few months, even though we've seen quite impressive performance June and July. However, usually what you should take away from these market cyclicalities is if there's one of those bad news, the market will take it harsher than it would in a different month. And since we've had this run up, there's space for money managers to take gains, to take money off the table. So it can easily, I won't say everything's going to start crashing back down, but there could be very easy high volatility coming back or creeping back, which might surprise people and spook people. So I wanted to reassure that this is just part of their markets, and to stay consistent and stay focused on the long term and not be spooked by the markets. So this is going to be our last slide. I have a lot to say. So 2 months ago, last month, I had COVID, unfortunately, and I was in no state to give a webinar. So we missed last month in the beginning of July. So last time I spoke to you all was the beginning of June, after we saw the May data, which is right here, is approximately when I last spoke. And if I remember correctly, what I had said was, although positive, or I have a positive opinion about the future of the economy, and that I didn't think there was going to be a particularly hard landing, and that I thought that inflation was going to get to 3%, which it did promptly after in July, that we were trading in a pretty consistent range between 3,800 and 4,200 on the S&P 500. And that it would be very hard to break out from that range. For those of you that don't follow financial markets, don't have any experience with technical analysis or anything like that, which would be most of you, you should know that usually when security trades within a range, it will stay within that range until it breaks out in either direction, either above the range or below the range. And when it does that, we would say the range is broken and it doesn't really apply anymore. And if you look here, the range that I had originally talked about, the 3,800 to 4,200, is shown in yellow. We had traded up and down. We broke under it, but quickly then recovered back up. We had dipped right above it, and then it came crashing back down. And right here, we had a lot of consolidation, what it's called, when there is a lot of short trading in a short range, basically showing that a lot of people felt comfortable in that arena and didn't have strong beliefs to buy a ton or strong beliefs to sell a lot. And it was the market was fairly priced. There wasn't actually that much volatility, that much run ups or anything like that. And when that happens, usually it means that it's going to either break upward or downward with some level of volatility. Now, I had simply said that since there's so many unknowns in the future, and that again, any of those bad jobs data, Federal Reserve saying something they shouldn't, or doing something they shouldn't, or a war breaking out, or any number, big bank failing, any number of things could have happened, and I could have easily see it dropping back down to the bottom of the range here. But from what I've been hearing from a lot of market commentators in the past, since essentially May, I've heard less and less talking about the potential for a hard landing, and they've changed their tone to saying, I actually believe, in their words, I'm saying, that a soft landing is possible. Before, making these numbers up, but say people had it at a 50% chance that it was going to trade flat, a 45% chance that it would go down slightly, the market would go down slightly, maybe a 5% chance or lower that there'd be a soft landing. Especially a year ago, very, very few economists believe that the Federal Reserve will be able to pull it off. It isn't all up to them. There's a lot of, there are thousands or millions of other factors that go into it all. But most people did not truly believe that there would be a soft landing where the Federal Reserve would be able to raise interest rates without causing a recession, without causing lots of people to lose their jobs. And essentially there was the belief that it was either we're going to have high inflation or we would have a recession. And it seems like we've threaded the needle so far, gotta say, and haven't caused too much damage to the financial system. There is strain. It is tighter. That's the whole point of raising the interest rates. But people have been losing their jobs en masse. There are strikes and other things happening that I wanted to cover today, but I don't think we'll have too much time to discuss, like the Writers Guild strike or anything like that. It's very fascinating, but talking from larger macroeconomic lenses, a lot of people didn't think that what we're seeing now would happen. 3% inflation rate, we were at 9 a year ago, and 4% or 3.6 or whatever it is below 4% unemployment rate. And we were about there a year ago. So very few people thought that one will go down without the other going up. And so far, we actually got that. And there are fewer and fewer true worries in the market. There's always unknowns. There's always black swan events that can happen. But the intrinsic, rates go up, so the economy must go down. Since that hasn't happened, a lot of money managers seem to have brought cash off the sideline. There was a ton of money just waiting in cash, earning basically nothing. And now the interests are high, there's a higher opportunity cost to move money out of cash. You'd rather leave it in a bank or in treasury notes and be earning 4, 5, 6%, depending on where you put your money. But as you can see in the past 2 months, in June and July, we've had incredible run up here. And that's showing quite a bit of optimism. There aren't sellers in this market right here. It's surprising me, especially because you can get a risk-free return of 5% with treasuries, that people are buying into this market with the risks. However, the market was oversold on a valuation standpoint because of the risks. And now that those risks have gone away, it's justified to start returning to those higher multiple levels because there aren't those risks. So with all this being said, I know I kind of rambled there, but I had previously predicted that we would stay within this range, and I expected that we were touching the top of this range, we might break up, but ultimately we'd probably come back down and trade within this range for the better part of the second half of the year, and maybe at the end of the year end within the range or slightly above the range. Thankfully, everyone's wrong every so often, and it's good when you're overly cautious or pessimistic and things surprise you to the upside. The market rallied quite a bit. It had some really great jumps, some really great days. A lot of this has to do with Federal Reserve announcements and such. One thing that I found very compelling, at least, to justify putting more money in the markets is you see these are consistent green candles. So this is what we call a candle chart in finance, and consistent returns, green positive returns over many days in a row. We had a very long winning streak that we hadn't seen in a while. And usually that means that there's a lot of euphoria, a lot of optimism in the markets, which is a good thing. It's a bad thing when you get head over heels and people are overbuying. However, when you see that, there's usually more volatility than this. There's more volume than this, but volume isn't particularly high, at least relative to the rest of the year. And you'd have larger candles, larger wicks, like over here, you see that these very long days over here. There was a lot of volatility that day and that week. We don't see that. There's consensus essentially that it's trading within a tight range going to the top right, and there's a lot of consensus that life is good essentially in the markets. With all that being said, today was an outlier. Fitch, the rating agency, downgraded U.S. debt from AAA to AA plus, which today was a very interesting day in the markets to see. Especially there was a large range of commentators coming on. It's like, why now? Why not before 2 months ago when there was a whole lot of worries about the debt ceiling? I wasn't particularly worried about that, but now that we're over the debt ceiling and inflation is down and employment's still up, and sure, the debt is getting higher and higher, but I saw a lot of commentators come out and say this seems strange timing, and also strange that now that the economy is AA plus, the U.S. economy, or the U.S. government, I apologize, the U.S. government is rated lower than some other developed nations that at least these other commentators are saying are on par or worse than the U.S. So it seemed strange. A lot of people didn't agree with Fitch's downgrade, but when a large agency like Fitch makes a rating change on something that is usually considered completely risk-free, such as the U.S. government debt, there's a lot of news headlines. So if you can see this last day, which is today, very large downward red candle. That could lead to nothing, where you have a red candle like here, and then right away it gets rebought up and there's a lot of euphoria again. Or there could be another scenario where it's the first red candle and then it starts dipping down, and we have some more volatility, some more losses and such. Personally, again, I'm being pessimistic and I was wrong the first time, but this pattern right here, exactly between February and April, seems almost exactly the same as right here. We're trading up, and then we started consolidating a little bit, some more volatility, all greens into some greens and reds, and then one big day down, consolidation, and then maybe some more pain ahead. So with all being said, I spoke quite a few words there. I think these next 2 months are probably going to give up some of the gains. I don't think there's going to be incredible losses, but I think we might have gotten over the skis a little bit. and or you might trade back down to 4,400 or 4,200. But thankfully, eh, we've broken the range. We've broken the 3,800 to 4,200 range. And I don't think the market is bound by that anymore. There's a lot more money in the system now that's no longer sitting the sidelines because people were waiting for the next recession. And the next recession didn't come. And a lot more people don't think it is going to come. So they're getting back into the markets now. Important lesson there, though, to always keep a long-term perspective that for those that sold down here or down here or down here because they were worried that a recession was going to come and are now buying back in up here, they're locking in losses and they're paying higher prices. You know, the saying doesn't go sell low, buy high. So being consistent with dollar cost averaging into the market, investing for the long term, not being spooked by volatility, all these mantras, we can say, are important to remember. And although these next 2 months, again, cyclicality of the markets, seeing August and September, probably going to be down in 8th if I had to guess either way. But remember, at the end of the year, I think that we're going to stick with the cyclicality of the markets, and we're going to see a rally in November, December, and I don't know where we will end, but so far the U.S. economy has been surprisingly resilient, and that's a good thing for the clients of Silverstone Financial that have money in the markets, and for you that has money in your 401k or other assets tied to how the economy and the stock market as a whole is performing. So that concludes this month's webinar. Thank you so much for listening. I saw one question come in throughout. If any of you guys has a question, please leave it. But it was just a quick question I had seen. Let me read it one more time. It was about housing inflation and housing costs being high, and how this person expected housing to have come crashing back down. Well, let me say, in my opinion, and what I had said about a year ago when I had a similar housing question, is I didn't think housing costs were going to come back down because inventory isn't going up, because building isn't there. There is building of new houses, but it's not tons and tons of building like 20, 30, 40, 50 years ago. The homeowner or the home builders aren't incentivized to have massive volume of new houses developed because they want high prices in houses because they can have higher margins. So they're not incentivized to build more houses. So right now, more and more people are stuck in very low interest rate mortgages, which is a good thing for them because of the low interest rates that came around during the pandemic. But that means they're less incentivized to move or to sell their house because they would have to replace that mortgage with a new mortgage at 7%. So new houses aren't coming to the market, new houses aren't being built. And because of the higher interest rates that cause the mortgage rates to be higher, we do see lower demand, which does help keep housing costs down. But essentially, it's kind of a wash where I see housing staying pretty flat for the future because interest rates are high, so demand is low, but there's no real inventory. So for those of you, I have some clients that are looking to buy houses and such. All the houses are still gone within a week, within 5 days. So it's still a very competitive market. It's definitely a seller's market. And I would expect that if you want to buy a house, you buy a house, and you shouldn't be expecting a housing crash because I don't see a housing bubble. It's very different from 2007, 8, 9 because mortgages are more tightly regulated and building is there's less development. So I don't see a bubble in the housing market bursting. I see a slow, flat movement. And as interest rates possibly come back down, or people can start moving more, depending on if they're sick of their pandemic purchase, we could see some changes in the housing market. But currently, I don't see very many changes. I think it'll be status quo for quite a bit of time. All right, I don't see any of the other questions come in today. So I want to thank you again for all attending. I'll see you next month. And if any of you guys have any additional questions or personal questions, please feel free to email me at my email below. All right, have a nice night, everyone.